The portfolio that we manage, the Credit Income Trust, is an unusual portfolio because it actually spans the full spectrum of credit investing. And by credit investing, I mean, we invest in bonds or make loans to the corporate sector rather than investing in government bonds, etc. So in Australia, that sector has been developing quite rapidly, particularly since the GFC period. And we've seen our investable universe expand, well beyond the traditional investment grade securities that we've been investing in for 25 years. Over the last 10 years, there's been a lot of issuance into the high yielding space. And that high yielding space, really is populated by some pretty high quality companies. So they may not be household names in all cases. They may not be listed on the stock exchange. But usually the sorts of companies we invest in are actually quite large. They've often got very, very strong markets, either domestically or frequently on a global basis. But at the same time, because they're less well known, they do pay quite a good coupon and add quite a lot of return to our portfolios. It's very interesting investing post a big market crisis. Now, we've been investing into credit markets for the last 25 years, so we've seen a lot of crises, and there's often certain elements of similarity and there's also a lot of difference. The crises all stress portfolios, and one of the interesting things about a crisis like this is it does show up the difference between well-constructed, sound portfolios and portfolios that take on too much risk. So, coming out of a crisis period, you have an opportunity to invest at levels which you don't normally see. And the way that markets recover from crises is often quite textured and sequential. So in this particular COVID period, we saw a very quick recovery in government-supported sectors, so the banking sector, various transport sectors, etc. While the high-yield sector really hibernated for a period of time, and at the moment we're seeing a resurgence in that sector. And I think it's one of the strengths of our investment portfolio that by investing in a very diverse manner, we can look at the opportunities. Post a crisis period quite actively. And the other thing I suppose to note in this particular period of time is that central banks have pushed interest rates to very low levels, and that's obviously affected returns in many of the alternative investments. So through the crisis, we saw dividends become quite unstable. A lot of companies were forced to halt paying dividends through that period, and things like term deposit returns have fallen quite a lot. So, in that period, we see floating rate credit, which is where we invest, as continuing to generate really quite healthy returns. And our outlook in that sector is quite positive. We think that'll continue for some time. One of the key advantages of having fixed income in your portfolio is the defensiveness, the characteristic of defensiveness that it gives to your portfolio. So during a major period of crisis, the fixed income is the bedrock that allows you to sleep at night through that period. So the very first characteristic that it gives to your portfolio in a crisis period is stability. The other key characteristic that it delivers is regular income. So one of our key objectives in our portfolios is to deliver regular income. And we continued to deliver regular monthly income through the whole period in line with our objectives. Diversity is really important. It's really valuable for fixed income investors for a number of different reasons. So part of it is defensive, but also part of it revolves around being able to add value to investors. So the defensive part of it is, by being diversified, you can spread your risks. And we don't just do that by investing a whole bunch of different companies. We also try to be highly diversified between different sectors, across different geographies. So whilst we are an Australian-focused investor, we do take advantage of global pricing and global opportunities. And then, we look at investing across different time periods. So some of our investments are very short dated, others might be, for 10 years, 10-year bonds, etc. And that gives you the advantage of different cash flows within your portfolio to take advantage of opportunities. The other key advantage that we see in being, having the ability to be widely diversified is that, markets ebb and flow, not fully in sync. And so there'll be opportunities at some points in time to invest in a particular subsector of the market. For example, immediately post the COVID period, the investment grade part of our portfolio was very productive. There was a lot of volatility there, and we saw a strong opportunity to invest, while the high yield market was really quite subdued at that point in time. There was not much issuance. There was a little bit more caution and stress in that area. Whereas at the moment, we've had investment grade securities rally quite a lot, so they've performed very well. And we're seeing a lot more opportunities now in that high yielding universe to look for investments. Yeah, so we have a very active approach. So our portfolios are not set and forget. They really are looking for the best opportunity day by day. And so at a macro level, we have a regular meeting to determine, our view on credit markets overall. That gives us a sense of how defensive we want to be, in the event that we see some dark clouds on the horizon, or how aggressive we want to be if we think, the outlook is positive. We continue at the moment to have a positive outlook. We think the short to medium term outlook in credit markets is still quite constructive. And then on a daily basis, we have a full range of specialists looking at each of the different sectors. So we'll invest into investment grade corporates, into high yield bonds and loans. We'll look at asset-backed securities, bank securities, and various global issuers. And that's a dynamic process. So we'd be looking to improve the relative value positions of the portfolio on a daily basis. We therefore end up seeing a portfolio that does turn over with some regularity. And that, is both great because it means that we're generating returns better than the simple coupon. So we can generate returns from trading gains as well as just, collecting the coupons and securities. But it also means that you have a portfolio which tends to be more liquid than a portfolio would otherwise be if you were just more passive in the way that you invest. Yeah, so look, once you start lending to corporations rather than governments, you have to research the credit. So in the end, it's a very good source of return, provided the obligor meets their obligations. So we need obligors. So if we lend to a company or we invest in their bonds, we need to ensure that they are both capable and willing to, pay the coupons that are due to us and to pay the principal at the end of the term. So we focus on the highest quality issuers. We do a lot of research. So the real key in credit markets is to research and to only select very positively if you've got a high conviction. So we're looking for companies that have got, a really good market position, really sound balance sheets, strong management, a supportive regulatory environment. Unless we have a very strong conviction around those issuers, we won't invest. And that's true across the board. It becomes even more true as you move into the high yielding part of the portfolio. So if you're looking at the smaller issuers, some of the private debt, that level of research and due diligence becomes even greater. Again, the structure of our portfolio really allows us to be very selective because we only invest into that high yield component when we see deals that we really like. So unless there's something we really get excited about and really are keen to invest in, we hold investment grade securities. And one interesting example of that, I think, over the last year or so that people might be able to relate to is the airline sector. So we did, in the post-COVID period, take some positions in Qantas. We felt that was a well-structured, market-leading airline. but we avoided, prior to COVID, exposures to Virgin, and those bonds haven't performed well. And we think for reasonably predictable reasons. It was not a leading company. It was not, a well-resourced or particularly sound financially structured company. The portfolio is split in a broad sense, about half between different corporates. And then we also invest in a range of bank and property securities. So in the financial sector, we do have investments in bank debt and particularly bank subordinated debt. We invest in a range of residential mortgage securities. And in the corporate space, we invest in names like IAG, Coles, Boral, Santos. So it's quite a diverse portfolio. And each of those holdings is probably on average around 1% of the investment of the fund. Yeah, so the portfolio currently has over 100 securities. It ranges across a full spectrum of issuer types and industry types, etc. So probably the majority of those are investment grade, but there's a large minority which is in the private debt and some investment grade space as well. The main reason that we like to have a large range of investments is really to control risk. The more concentrated you are, if something does go wrong with a particular issuer that you haven't foreseen, the impact on your portfolio can be large. So we try and mitigate risk by being very diversified. But it also has a subsidiary benefit of, it's easier for us to trade in and out of positions. We're not trying to sell large holdings if we want to exit a particular position because our view on that risk has changed. So there's a lot of benefit for diversification from a defensive perspective, but it's also really useful to allow us to be very active in the management of positions and to take profit as we see opportunities. Fixed income portfolios are exposed to a number of risks, and each of those risks actually also provides opportunities. The biggest individual risk is probably interest rates. So in an environment where interest rates potentially are rising, which is one of the concerns for the market at the moment, having long-dated fixed-rate securities can be quite risky because as rates rise, those securities will potentially lose value. The portfolio that we manage is a floating rate portfolio, and so that particular risk would be a benefit to us. If rates do rise, it would generate an increased return to our investors. So that's a key risk in fixed income markets, less so in credit markets, which tend to be floating rate securities. The next risk, of course, comes from that very dynamic, which is we are lending to non-government issuers. So we're lending to corporations, we're investing in mortgage securities and various things. So the risk there is that we don't get repaid when the bond matures. So that risk of the issuer defaulting is something that we're very conscious of, and that's really our key focus. We spend a lot of time making sure that we research the issuers properly and that we only invest in ones where there's ample evidence that their capability of repayment is there for the time frame that we're looking at. The third risk is just markets. So, credit securities, like all securities, trade in a market, and in periods of market stress, the market credit margin on our securities can widen. So investors will demand a higher risk premium to invest, and so that potentially has a negative impact on the market value of securities. And we did see some evidence of that in the COVID period, where credit portfolios did lose a small amount of market value through that period. The pleasing thing in our case is that movement was quite small, so the impact was well controlled. And the final risk, I guess, is just around the liquidity of portfolios. So you're investing in issuers where there's less of a liquid market. Government bonds have got a very deep and liquid market. Corporate bonds have got a fairly deep and liquid market. Sub-investment grade bonds, private debt, obviously are less liquid. And so when we're investing for a term into less liquid securities, we need to make sure that our investor base is aligned with that. And again, it's one of the strengths of the Credit Income Trust, being a closed-end vehicle, that aligns the liquidity of the investments with our investors. So we can take, we can make good investments into securities which are less liquid. The upside of that is that there is quite a good premium to doing that, so we get a higher rate of return. Look, credit is an asset category that really does two things very well. It gives investors a very defensive and stable core part of their portfolio. And so, you want to be in that position to withstand, volatility in other areas. So having a good solid core to your portfolio means that you can comfortably invest into other risk assets as you like. But at the same time, credit has historically been a really good return generator. So, you're not sacrificing a lot of returns for the stability that you're getting. And, we've been investing in these markets a long time. And I think provided you've got, a diversified portfolio, a conservative portfolio, and, you've got a process that actively looks for opportunities, you do get a good combination of that defensiveness that fixed income is designed to deliver. And credit does, deliver good performance for investors.